Hey, rent retirement investor, Zach Lemaster here. I want to do a quick update on this exciting new loan product that everyone's been reaching out about since we put out our last video a few weeks ago about the 100% financing product. This is a product, if you haven't seen the first video interview that we did where we ran through an analysis of like what this loan product is and how it can be used effectively, please take some time to certainly watch that. This is an update to that initial video. We'll also put the link to that initial video, which is a more in-depth analysis in the notes for this video. We recorded that maybe a month ago, and this is a dynamic lending world we're living in right now. Things have changed, and also property availability has changed. Right now, we currently have a wait list because of so many people interested in using this loan product to aggressively grow their portfolio creatively. We did a updated analysis on just kind of a general property based on current loan terms. Interest rates have gone up a little bit. That doesn't change the overall concept, but it does alter the timeline for this potentially and just some of the numbers. So hopefully this updated version will give you a little bit more concrete details on exactly what you're looking for. Just as a quick overview on this product, this is a product that we recently learned about from a local credit union and we've been working with that is an investor-based portfolio type of loan. Just to review, this is a portfolio loan. This is not one of your 10 Fannie Mae, Freddie Mac loans. This is a portfolio loan that this credit union is lending in-house. Since we found out about this loan, we've reached out to hundreds of banks and credit unions to see if someone else is offering a similar type of product. That way we have more banks to offer this product in different locations, and we simply haven't found one yet. So fortunately, we still have this loan option available, but this is really the only bank that we're aware of that is able to finance this in the specific locations that we're going to be talking about. But essentially what this is it is a 100% finance loan product, meaning you're putting no money down. You still will have some closing costs potentially, which we'll talk about, but you're putting no money down on the loan. The lender is actually financing 100% of the loan product. Now, naturally, when you have 100% debt on something, you would anticipate that it's probably not going to cash flow very well or likely even be negative cash flow, which is okay if part of your plan is acquiring more real estate with less money out of pocket to overall grow your portfolio, which then will appreciate over time. You get the tax benefits and depreciation over time. The loan is paid down. And so if you're going to hold this for say 5 or 10 years, even though you will be negative cash flow in the beginning years, or even a good portion of those years, potentially, you're still growing your equity, right? You're growing your equity through the appreciation of the house. Rents will go up over time to reduce your negative cash flow year after year and eventually be positive cash flow. Equity is growing through the appreciation of the house and the loan pay down through the amortization scale, which if you look at the numbers, this is a creative way for you to grow your portfolio without having to come out of pocket extensively with a bunch of capital. And you don't have to use this product, right? You don't have to use this at all to buy this. You can use a normal conventional loan, or you could put a percentage down. You don't have to use a 100% down loan. If you do not want to have that much negative cash flow exposure, say on one of these or multiple of these, then maybe it makes sense for you to put 3, 5, 10% down on some or all of these to reduce your negative cash flow, but still not have to come out of pocket with a full 20% that's going to be limiting, your buying power. Capital is the most limiting factor for all of us to grow our portfolio. And one thing that has served me well in my investing career over the years is simply being creative to acquire more real estate with less money out of pocket. I'm not necessarily living off the cash flow from my properties today. I want to make sure my portfolio as a whole, with all properties combined, have a positive cash flow. And I'm able to support some negative cash flow from some of these properties potentially with my portfolio that's already cash flowing in other locations. But this is a way for at least me to acquire more real estate with less money out of pocket and then get the additional tax benefits and equity growth over time, which is really what grows your net worth and allows you to scale quicker, which is really what it's all about. So I think this is a very interesting option. If this is your first time learning about this, please, reach out to our team and learn more, go through the steps of educating yourself. This certainly is not a right product for everyone. This is not a requirement. You can come in and buy some of these newly built properties with whatever percentage down, whatever loan product. It's not up to us to determine what lender to use. That's up to you. We're just here to educate you and present you with opportunities. So just to review, this is a 100% finance product. This is a portfolio loan, meaning it's underwritten in-house with the bank. They come up with their underwriting criteria, but it's very similar to how they're going to underwrite you for a conventional loan. So they are still going to look at all your financials. In fact, a lot of people that have tried to apply for these have not been approved, frankly, because of DTI requirements and things like this. We'll talk about that more in depth in this video. But that's the first step, is just getting approved to see if you even qualify for this product. Just because it means that they're financing 100% of this doesn't mean if you don't If you don't have money to put down or you're not in a good spot financially, you're not going to qualify for this loan, and we wouldn't recommend it anyways. But if you're someone that has a strong financial position, you have money in reserves that you can use, or you have a positively cash flowing portfolio that will support maybe some negative cash flow, an option for you might be, instead of putting your money down, say if you had, 50, 60K or whatever to put down on a property, you could do that. Or you could use that money and actually keep it in reserves to offset the negative cash flow years and use this loan product with no money down to buy multiple properties, furthering growing your portfolio, which, as you'll see when we run through the numbers, if you acquire more properties over time, there's a compounding effect that you're growing your net worth, and you have the compounding tax benefits. So this is a portfolio loan underwritten in-house. The lender will qualify you just like you probably would for a conventional loan. You have to turn in all your financials and things like this. There's a max of 5 loans that you can have individually with this lender. So if you do 5 and your spouse does 5, and you're on those separately, you can have those, but you're limited to 5 of these at any point in time, at least with this lender. The main thing to point out here, and I think this is really crucial, and I forgot to mention this on the first video, so this is really important. There is no prepayment penalty on this loan. And that's a huge point. Most portfolio loans or commercial loans, at least in our experience that we've dealt with, have prepayment penalties. Often it will be a step down, like a 5, 4, 3, 2, 1. Where in year 1, you have 5 points if you want to sell that property or pay it off or exit it. And the next year steps down to 4. Some are more or less aggressive. The point is, most portfolio loans that we've seen have a prepayment penalty. And that is challenging because that means you're basically stuck into the loan. If you want to pay off the property or sell it like 6 months later, 2 years later, you are charged to do that. Whereas in this case, there is no prepayment penalty. And that's vitally important to understand because it gives you flexibility. If interest rates come down and you want to refinance this loan sooner, then you certainly can at no penalty. Or if you want to sell the property off, let's say it appreciates quicker than you anticipate, or you simply just need to exit this for whatever reason and not end up holding it, you can do that with no penalty. We all know that interest rates they're high right now, right? And we just got an interest rate spike last week, which is projected to be the last interest rate spike we're going to have, at least for a while. So likely interest rates later this year and into next year will start to come down. Now, this loan product will likely still be available. And so you could easily potentially refi. I mean, there's going to be points associated with that or loan costs, but it might make sense if this comes down like 8%, 1.5%, whatever the case is. Maybe you keep this loan structure in place and you refinance to allow you to not have as negative cash flow, but just something to think about. This is a loan product we're super excited about. We're personally doing, not only myself, but most of my team over at Rent to Retirement, because we like the idea of growing our portfolio and using our capital wisely, both in reserves, but also using debt and leverage responsibly and strategically to be able to grow our portfolio, compound the tax benefits and the appreciation over time and the rental growth to really see how this makes sense to grow your portfolio. So let's actually look at the updated numbers and go through a more specific example. Okay, everyone, here's an example of an updated loan structure and property example. We chose a property with the Alabama new construction that these are currently being offered on, somewhere in the middle of the road. I chose a purchase price of a house. This is actually a specific example that we pulled from recently. And the purchase price here was basically $260,000. Okay, $259,900. We have zero purchase costs. That's with additional costs here, but we do have closing costs. This is loan costs here. So what the seller and builder is offering is, at least to the Rent Retirement community exclusively, is they're doing 2 things. They're offering a 2% closing cost credit that's going to offset the majority of your closing costs. You're really are not going to have very many closing costs, but you probably will still have some. This isn't going to cover all of it. So you will be out of pocket a slight amount. In this particular case, this investor was out of pocket closing costs just under $4,000. At 2% at $260,000, you're just over $5,000 of points that the seller is covering, at least for the time being. That's probably not going to be forever. In addition to that, the seller is offering a corporate rent guarantee for the first year. And this is vitally important because this means that if the house, most of these or all of these are new construction, some are already built, some are just in the final stages of completion, and you're buying them once they're completed, right? You're not buying them before they're completed. These are already completed houses ready to be rented out. But this is important from a corporate lease guarantee because you can rest assured that you're going to be receiving the rent that is projected starting month 1. right? And that's important both for you, your reassurance. So, hey, if this were to take a month or two to get leased out, I think your average leasing time right now is about 40 days. You're not stuck having to pay your mortgage and expenses without any income. They're guaranteeing your income for that first year starting in month one. And that also allows you to qualify for more of these because it's less of an impact on your debt to income ratio. Your debt to income needs to be 43% and 740 or above to get 100% down. If you're below 740, I think they require like 5% down. So it's still attractive. But this is a scenario where you do need to have good financials to qualify for this and be in a good position financially, because this is a risky loan to the bank, right? I mean, they're taking on 100% of the debt, and they would only do this if they're very confident in the market and the team that's operating these. They do not lend just this product anywhere. So please understand that, which should give you confidence to invest in the area, but know that you are going to be required to have 740 credit. And the DTI requirement, basically, if you have a lease in place, and this goes across the board with any lender, but this is why the corporate lease is important now, not only to give you the reassurance you're going to receive income, but also it's not going to have a huge negative impact on your DTI. It will have a negative impact to some degree, but what they can do, the lender, they can take 75% of the rent amount to offset the debt on this property. So it's not going to be just this huge impact on your DTI, but it will probably have some negative impact. Most people we've seen, because right now we do have a wait list on this, guys. If you're interested on this, I encourage you to take action. We don't know if this loan product is going to stay around forever. And certainly there's only a number of builds that this is available on. And right now we do have a wait list. So the timing is of the essence. And we would encourage you as a first step to get qualified and then reach out to our team once you have that qualification with the lender to then start picking out properties or at least getting on the wait list. And most people have been able to qualify anywhere from like 2 to 4 properties. Some people have qualified for up to 5. Some people have qualified for 1. It really depends on your situation, but you just have to go through the lending option to get pre-approved. And the lender obviously is slightly delayed because of all the influx of interest that they're getting. You would anticipate a 1 to 2 week turnaround time to get qualified. That's step one. So anyways, wanted to mention the corporate lease guarantee. That's a huge benefit this builder is offering to the Rent Retirement Network, and something we've negotiated hard on this for you. They actually did not offer this in the beginning, and it was hard for people to qualify. And we went back and negotiated hard for you guys. We're always doing that. So with this loan product, big thing to note, interest rate currently 8.5 if you're 740 and above credit. I think my previous example, I was in the 7s somewhere, but certainly that was outdated. And so time has went by and interest rates, where they're at now. And this is always changing, right? It'll probably be outdated. But what they've told us is that they do not anticipate it to go above 8.5. If anything, it might come down a little bit, but this is where they're at today. And this is what we're basing our loan off of. So we have a $259,000 home price in this example, about $4,000 out of pocket cost. That's a monthly payment of just under $2,000. Monthly rent on this is $1,595, so just around $1,600. There are some properties that are more expensive than this, and there's some that are less expensive than this, at least with the new construction in this area. And this is what we based our numbers off of today. So we'll go through, and again, if you haven't, you should have access to our Rent Retirement Wealth Calculator. The whole purpose of this calculator is to allow you to track multiple properties. You can have, we just put one in here, but you can add multiple properties, and this will give you a portfolio analysis of both where your current and anticipated future cash flow and equity position will be. Because we know over time, rents will go up and equity will certainly go up with appreciation, but also the debt reduction with the tenant paying the loan down. And then you can scroll here to kind of project out where you're at. If you're going to hold this property for say 15 years or whatever the case is, or, in this case, 18 years, you can see where you're going to be to have some financial planning. I think that's really important. So let's go back and view property. So play around with this. You can add more in here, even your previous portfolio. If you're not interested in this stuff, add your portfolio. You can log in here, to save this. So year one on this property at 260, this is no money down on this. This is 100% financing. This is a 30-year loan is the amortization scale, but it's a 10-year term. So that means in 10 years, the property, you need to pay this loan off. You need to either refinance it, sell this property, extend this loan if it's available. So that's just something, we'll talk about. So we're going to be looking at, okay, over 10 years, does this make sense to hold this? The closing costs here, remember, about $4,000. So year one is going to be the most challenging, right? Because This is where you're going to have the most negative cash flow. You haven't had a chance for any rental increases over time yet. So year one, and just know that there's a lot of information on this. The return section gets a little cattywampus here. It's a little confusing just because it confuses a calculator when you have zero money down, and maybe don't look at this so much. But I've extrapolated out, just like I did on the other video, the important numbers that we'll look at over a 10-year hold period with this spreadsheet, and we'll send this to you as well to look at. But just so you know where the information came from, first year negative cash flow of about $8,400. So that's, after your debt, your expenses, we've already factored in maintenance and vacancy. Even though this is new construction, you should not have any maintenance first year. Like, we've already factored these sort of things in for full expenses and your debt service. You're probably around $8,400 negative cash flow year one. That's roughly $700 a month. And please understand, every single property is different. The more expensive properties on here might have a higher negative cash flow. That's to be expected, but you likely will also have higher rental growth and appreciation over time. Lower priced properties that you're doing with this will have less negative cash flow. This example is not the same for every single property. Just understand that. It's important for you to play around with this calculator or run your own numbers and look at what your properties are going to be actually performing at. But we chose one that's kind of in the middle of the road as a general evaluation. Cash flow on this, negative $8,400 year one. We can see I ran a 5% appreciation projection, which is conservative for this area. Again, investing in the Southeast, the Sun Belt. Most of these areas, we're seeing, ignoring the past 3 to 4 years, which has been higher than normal appreciation. I think 5% is very conservative. A lot of these areas we've seen, I would say an 8% on average, but everyone wants to be conservative. So year one appreciation, we're looking at around $13,000 on a $260,000 house at 5% appreciation. And then, of course, you paid the loan down about $2,000. Now, this is not speculative. This is just built into your amortization scale. And so you have a total equity here of about $15,000 after year one, even though you've had a negative cash flow around $8,400. That's how we're looking at the pro forma. This is end of year in this column right here. The middle column is cumulative, which will be the same for year one. But as you jump down here to year two, you can see your negative cash flow. It reduced a little bit because we had rental increases. And I believe we're projecting a 4 to 5% annual rental increase, which has historically been exactly what this management team has been doing in this area, often writing it into their leases, very confident about the rental increases. And then you can see cumulative is adding year one and adding year two. So this would have been your total negative cash flow over 2 years. And then in year two, again, at a 5% appreciation, roughly $13,500. But total, we would have had an appreciation of $26,640. We would have paid down $21,380 in year two because your amortization, the longer you have a property, every mortgage payment you make, you're paying more and more principal. So the longer you hold the property, the more principal is paid down on each loan. And here we have a total pay down after year two, combining year one and two at $4,103 for a total equity of $30,743, including the appreciation and the loan pay down. Going down into year three, we can see cash flow, and negative cash flow is decreasing and your equity is increasing. And then you go down to, probably in this particular example with these current loan terms, around year 9 or 10 is when you actually get into being positive or break even cash flow. And of course, by owning it after 9 or 10 years, you would have had significantly more equity over time. So feel free to play around with this calculator, and you can see in year 10, we're now positive cash flow. But let's actually jump over to this sheet because this allows you to compare side by side a little bit more year to year. And just to review on this specific example, this is a property that's $260, $1,595 for rent, 8.5% interest rate at 100% financing. Again, if this is too aggressive for you, but you still like this concept, maybe it makes sense to put 5% down. Also, when you put 1% down, it's less risk to the bank, even 5%. And so maybe this interest rate drops some, in addition to having your loan balance be less. So that might be able to help with not having as much negative cash flow. You do not have to do 100% financing on this, even though that's something that I'm personally doing because I like that idea. And we'll talk about the tax benefits on how I'm very aggressive, especially this year in 2023, doing accelerated depreciation to really make a dramatic impact on our overall portfolio and financial position. This is very much a tax play for us. Just wanted to point that out, because if this looks too aggressive for you, that's okay. Maybe that means you put a % down on each one of these and it dramatically reduces the negative cash flow, or is potentially a break even. But you can kind of see in this example, if you have the option to obviously buy with 20% down, but does it make more sense to actually keep that 20% down on this property, which, let's run the numbers at 260. 20% down would be $52,000. So does it make sense to put that $52,000 plus closing costs actually down on this property to be positive cash flow? Or does it make more sense to hold that $50,000 in reserves and potentially buy 5 of these properties, right? Where you have that $50,000 set aside for reserves to cover the negative cash flow years. But by doing that and running the numbers and running the projections, that after 5 to 10 years of holding this thing, you're going to be way further ahead in your overall net worth and portfolio, simply by the appreciation, the debt reduction, the loan pay down, the tax benefits and depreciation, all these things combined per property that you own to actually increase your net worth. That's what we're trying to point out here. Again, not saying this is right for anyone in particular, but something to think about. So year one, negative cash flow, you can see here, 8,400 each year at a 4 or 5% rental increase. We're expecting the cash flow to become less and less negative because you have rental increase, but your mortgage does not change. And again, we have a percentage for maintenance and things like this and vacancy factored in this. But the reality is, like year one, you will have 0 vacancy and 0 maintenance because it's a new build. You have a comprehensive builder warranty on everything. And you also have a corporate lease guaranteed for that first year. So the reality is, it's probably less cash flow there, but important to factor those things in. And then you can see year 9 and 10, we're about break even and then positive cash flow into year 10. So year 10, which I did not run a full 10 years last time. I kind of looked at year 5 because that was kind of the break even point of the last property I evaluated. Each property is different and the loan terms are always changing. But at least in this example, I think it's important to actually look out. Let's go 10 years out, because this really is not about the cash flow scenario. This is about making sure you have reserves to cover the negative cash flow. But if you look at an appreciation and debt pay down and depreciation schedule to look at where you're at after 10 years of holding, it actually becomes more attractive than holding for 5 years. So I truly believe that this is either a 5 or 10 year play. But in this video, let's focus on year 10 instead of year 5. So you can see over time, cash flow becomes eventually positive, and you need to hold this amount in reserves. Then we have annual appreciation. This is cumulative. If you remember from the middle column, we pulled the cumulative cash flow. So this is not saying like in year 3, you had $40,000. This is adding up year 1 and 2 and 3 for your annual appreciation projected at 5%. You can go into the calculator and run whatever percentage you want to, but I mean, this is reality. Houses appreciate, regardless of short-term fluctuations. And 5% is, I think, completely reasonable to use in the Southeast Sun Belt, where you have population moving all the time in areas of Alabama. This team is really building kind of between the Huntsville and Birmingham area. We all know that Huntsville is a super hot market, but that area is, I think, highly sought after for renters and homeowners. These are great areas. Often, if you look up the schools in these areas, they're highly rated schools. And these are, still affordable secondary markets to invest in, where maybe it's not, downtown Huntsville where you can't get positive cash flow with even 30 or 40% down, but this still, is an area that is growing because of just the general metropolitan growth in that area. And we're not focusing too much on the exact markets because those change time to time. And this is something you need to discuss with your R2R rep to see what the availability is. But in general, these are kind of the ideal areas that we want to focus on for this type of product, because we know that they're growing in rents and appreciation. So over time, we can see year after year, the house is appreciating at just running a 5%. This becomes pretty dramatic over time. And this is just on one property, right? So if you owned this property, you would have negative cash flow really up until year 9 or 10 in this case, which doesn't sound fun or attractive. But when you actually look at the numbers with appreciation at 5%, you would have $163,000 just of equity just in appreciation, not including the debt pay down. And so, this number could vary. It could be above or below this line. But if you're comparing this to the negative cash flow that you've accrued year after year, you are still coming out way ahead, right? I mean, I think you can see that you're still coming out way ahead on the appreciation. Now, when you factor in the loan pay down, which again is not speculative because this is built into your loan structure when you close on it, this is exactly how much principal you're paying down each year, okay, through the loan pay down. And so you can see this goes up and up and up year after year of how much loan is being paid down to increase your equity. Again, this is cumulative here as well. And so year 10, go down to a 10-year hold. I will probably personally hold these for much longer than 10 years, but this is something to look at, just where you're at with this. Who knows, maybe we'll just end up paying them off or do a 1031 within that time frame. But you can see after year 10 here, you are starting to be in positive cash flow. You have $163,000 of appreciation, and you have roughly $30,000 of loan pay down, which total equity combined is around $193,000. So really the concept becomes, okay, does this make sense to put money down on this property to just buy one of these, or does it make more sense to actually keep money in reserve and buy multiple of these to then dramatically increase our net worth over time, just by scaling and simply owning more real estate over time? So let's do an analysis. Let's say if you did 5 properties, right? Because again, I like to be aggressive and own more properties with less money out of pocket, because I will go out and use that money still to invest and have reserves. But let's just look at the scenario. So over the course of 10 years of holding this property, you would have had a negative cash flow at $39,000. The equity in this property would roughly be holding 10 years at $193,000. This is through appreciation and loan pay down, just as we show right here, right? And we're not factoring in the tax benefits and depreciation, which we'll talk about. But just normal depreciation, which is dividing the purchase price divided by 27 and a half years, right here, you have roughly $9,500 annually just in normal depreciation if you're not doing accelerated depreciation, right? So we're not even factoring that in these numbers, but that's important to point out. And also the negative cash flow here, this is also a write-off, right? This reduces the cash basis on the property, and so this actually has a impact on your tax scenario currently and also in the future with this property. It's important to know, like, a negatively cash flowing property does come into play for cash flow. It's hard to stomach potentially negative cash flow, but it would come into the tax purpose year after year, as well as when you sell the property, it creates a loss and reduces your cost basis on the property. So just keep in mind the depreciation, overall tax benefits certainly need to be factored in here to see if this is right for you. So here, $9,500 of annual, just normal depreciation. And then you have your negative cash flow, which year one, $8,400, that's almost $20,000, just adding the negative cash flow and the normal depreciation, that you're creating a loss. Losses carry forward. You can't use up your loss in year one and then it's gone. So these losses on properties carry forward year after year. Also, this is not factoring in your mortgage interest deduction, your expenses on the property, your loan closing costs, your taxes and insurance, your management cost. All these things are going to create a huge tax loss on this, where, probably I put $20K on here per year, but realistically in the first 5 years, you're probably closer to $30K or higher year after year just in tax benefits. Everyone's in a different tax position, so we're not going to focus on that too much, but that is a reality. Like, everyone has that loss that carries forward and reduces any future positive cash flow, taxable liability, as well as when you sell this. So something to think about, but not to get too into the weeds on that with this. First property you buy, if you just bought one, negative cash flow, roughly $40,000. That's already below 20% or 25% to put down to buy this property, right? So that's something to think about. This is not all in year one. This is over the course of holding this 10 years. If you think about it, you could put, 20% down, which I think was 50-some thousand, probably 60,000 when you're at the point of closing costs and things like that. Or you can just carve away year after year over time, roughly 39,000 to weather the storm of negative cash flow. And then you would have created equity at 193 through your annual loan pay down and your appreciation. Now, where I'm going with this is to be a little bit more aggressive and actually acquire a portfolio, more properties here, right? So let's times this by 5, because you're limited to 5 properties per person. So if you were to actually buy 5 of these properties over the course of 10 years, you have a negative cash flow projected at around 196,000. And that is over the course of 10 years. It's not like you need 200K in reserves year one, right? But certainly you would probably need your negative cash flow in reserves, call it 10,000, just to round up from 8,400. probably $10,000 per each year set aside for negative cash flow, I think is an appropriate amount to have in reserves. So you don't need to have this all year one. So that's where that $50,000 came from right here, is having enough reserves to cover your negative cash flow, zero vacancy and zero maintenance on these properties because it's new construction with the builder guarantees, the warranty, as well as the corporate lease. So if you bought 5 of these, $200K negative cash flow over 10 years, but then if you look at the equity position, all we do is take this 193 times 5 properties, right? And you're almost $1 million in equity. And this is where this becomes extremely powerful and you see the compounding effect. Like if anything should stand out to you about everything we've been talking about right now, it should be this number right here. This number is what we want to focus on at a 5% appreciation and your loan pay down. You're looking at an equity position of almost $1 million. That means if you bought this five of these properties with zero money down, or just maybe $3,000 or $4,000 of closing costs per property, and you were able to save $10,000 a year per property to cover the negative cash flow, and these are rough estimates, right? But generally speaking, you would have created $1 million of equity after 5 years. So if you reduce out the 193 negative cash flow over 5 properties, you're still $800K in the positive here. Now, the alternative is putting that $50,000 or $60,000 down on one property to still have appreciation and debt reduction and some positive cash flow. But if you look at this over time, and this is where real estate gets exciting to me, and compounding this is actually growing your portfolio. So if you look at this, buying one property with 20 to 25% down versus no money down and creating close to $1 million in equity, this is dramatic, right? We've probably all heard the term before, like, what's the most predictable way to become a millionaire? Or often, what is the fastest way to become a millionaire? I'm not saying there's any fast way to do it, really, but the simple answer is buy $1 million worth of real estate. If you just buy $1 million worth of real estate, if you buy one house that's worth $1 million and you put a 30-year loan on it, in 30 years, you'll be a millionaire. And likely that house would have been worth way more than $1 million. But this is a way, if you really like in 10 years, if you wanted to create $1 million of equity and you have reserves and the financial capability to do this, in addition to the other things you're doing in real estate, this can be dramatically impactful, right? To control this amount of real estate and create, significant equity, to have $1 million of equity. So you can cash that out. You can put a HELOC on it. You can 1031 and then go invest $1 million and continue to scale up and put that down on properties where you have positive cash flow. This alone could be a retirement plan if you can get through these 10 years. And I think a very comfortable one for people. I don't see any 401ks or stocks or options where people can go and create $1 million of equity with little money out of their pocket and relatively low risk within a 10-year period. This stuff is exciting to me, but it's particularly exciting when we talk about the additional tax benefits, right? And this is where I'm going to finish off here. This is not something that everyone is going to be doing with accelerated depreciation. But if you are, and if this is something that you're thinking about, you certainly need to look at this and think about how this plays into your tax structure, especially this year, because 2023 is the last year, at least in my opinion, where taking accelerated depreciation on something is extremely attractive, because we have a step down from the 2017 Tax Act. Basically, taking bonus depreciation on properties is something that real estate professionals do, meaning people that are actively engaged in real estate, and you can write off against all income sources. We have all sorts of resources out there talking about cost segregation and accelerated depreciation. Go and learn about that, and we can obviously educate you on it as well as your CPA to see if it's the right thing for you to do. But this is something I'm personally doing, and our goal every single year is to buy enough property to fully offset our taxable liability and create a loss that carries forward year after year. And we've done that successfully over the past 3 to 4 years. The challenge is always like, okay, we got to save up another 20 or 30% to put as a down payment on another property to then have more tax benefits on. That has always been the challenge. So when I look at this is a no-brainer for me personally, because this is a way that, like, year one, yes, I'm going to have a little negative cash flow, which is also creating a loss tax-wise, but this means I get to control, another $1 million plus of real estate in this example, plus I get the tax benefits without having, a significant amount of money out of pocket. No brainer. So we'll use this to offset our income and to create a loss in future years, year after year. And so you really, instead of putting the money down on this and instead of paying money to Uncle Sam, This is money that we can then go out and reinvest. And I guarantee you that I will make more money reinvesting that money that I would have otherwise paid in taxes to offset the negative cash flow on this. But without getting overly, excited and in detail about this, let's just look at the depreciation and tax benefits briefly. So again, just normal depreciation on this property. If you're not taking accelerated depreciation, you're creating a loss, a passive loss on this property for about $9,500 year after year, every single year. That's just normal depreciation. But then we also take in the negative cash flow, right? That's also creating a loss. Like in year one, call it 9,500 plus this 8,400. That's, 18,000, right? Roughly $18,000 of negative cash flow. And then we factor in, the other tax benefits like management expense, your closing costs, and your attorney fees if you set up an LLC, your lender costs, your property insurance and taxes. That's probably another $10,000. So you probably have a $30,000 loss. That is, and $25,000 to $30,000 year after year, just normal tax benefits, normal losses. So that's dramatically important. But if you are an investor that is taking accelerated depreciation, this is where this becomes really exciting. And let me say this too. I'm not a CPA, consult with your CPA. I'm not an attorney, consult with your attorney. A lot of the investors that we are working with are in the position where they're like, hey, how do I qualify for real estate professional, right? Like, how do I do that? And the common consensus is like among CPAs that I've talked to is like, well, if you own enough rental real estate, it should be a fairly easy thing for you to qualify for. A lot of people are actively working in their W-2, they're high paid professionals that are investing. It's a little bit more challenging for them, but maybe they have a spouse that's a part-time employed, or maybe is not employed at all and stays home with the kids. Maybe they should be on paper or in reality, actually overseeing the portfolio, and then them qualifying as a real estate pro can offset your taxable liability that you earn from your active income. Something to think about. So also, does this come into play? Buying 3, 5 properties, whatever the case is, does this come into play of your overall tax structure where this helps to actually justify you as a real estate professional or your spouse? Because this is an easy way just to own more rental real estate, right? And I don't want to tell anyone specifically what to do with their taxes. Certainly, I recommend working with the right CPA. But like if you own a portfolio of multiple houses, maybe across a couple of different states, even if you have property management, you got a lot of hours and a lot of doors, and this is an easy way to acquire more doors. Maybe this will help to justify you as an RE pro. Something to certainly think about and discuss with your accountant. $300,000 in this one, and it's actually $260 based on our example. I did run the numbers correctly. So 25% of $260 is $65,000. Where I'm going with this is that generally on my cost segregation studies, you actually get a study back. It's done by an engineer to tell you like what things are not going to last for a full 27 and a half years. So a lot of the things in the house, you can take what's called 100% bonus depreciation in year one, and actually take that loss in year one against all income sources, active income sources. My wife still works occasionally as an optometrist. It even writes off that income, any other investments we have. Generally, the study we come back with is between 30 to 40%. That is a real depreciation analysis that we get from actual studies. We usually run our estimates at 25%. So we'll be conservative in this example because everyone wants to be. But the reality is that most of the studies we see between 30 to 40%. So you actually have to get the study to see where you land. At $260,000, so $260,000 purchase price, take 25% of that. That gives you $65,000 of immediate write-off. This is on year one, and this is across all income sources. So if you made $65K day trading, working in your normal job, real estate, if you're a real estate professional and taking accelerated depreciation, this is a $65,000 offset against any income sources. And this is on one property. I fully anticipate this to be much higher than the 65,000, but we'll be conservative in this case. So 25% of 260, 65K on one property. Now, if you did that with 5 properties, like we are, 65K times 5 is 325. Okay, and this is the write-off that you would potentially get across this entire portfolio. I think this will be closer to 450, 500,000 on these. I haven't got my actual studies back. I got estimates back. And if you need a cost segregation specialist, we certainly have one that we can recommend as well as CPAs. But the cost seg person that we recommend, Steve Tressel, is the same guy that I personally use. and he does do reduced rates for the rent to retirement community. I believe it's less than $1,000 for single family residential. And yes, you can do cost segregation, accelerated depreciation on single family residencies. A lot of people think it's just something to run on commercial. We do this on every single property we buy. Certainly right now, after this year in 2023, we may not, because the step down is at 60%. And quite frankly, we've been so aggressive in our buying over the past few years that we have a significant loss that will carry forward year after year and probably wipe out our taxable liability for the next 2 to 3 years, even if we don't buy another property. And that is done by intention. That has been our goal in being so aggressive. We bought a ton of real estate, and this is where this particular opportunity completely fits in this strategy, because we simply want to buy more and more real estate in good areas with good teams where we are confident about those areas, especially new construction. By the way, you get the best accelerated depreciation on new construction because everything's brand new. And so this is where this is going to be most effectively used, and why we're excited about this. But if we take that against a 37% tax bracket, that's a reality of an actual $120,000 that we would otherwise pay in taxes, whether it's this year or carries forward to future years. This is $120K to invest. I am fairly certain, in fact, I am positive that I can take this $120K to go reinvest and leverage and buy more property to have more tax benefits and then cover the negative cash flow here. So that's the way you guys really should be thinking about this. And whether or not you're doing accelerated depreciation, again, this is a way to buy more real estate and maybe put you into that category where you could qualify as RE Pro, something to think about. But I think the reality is if we're closer to, 500,000, then, this is roughly over $200K in accelerated depreciation that we're taking, year one. So this is dramatically important to think about. And again, this tax bracket is just federal, right? This isn't considering any state tax. So any of you, California residents or New York residents or people living in areas that have high state income tax, even furthering the point for you, right? Where this is going to be more impactful for you. So hopefully, guys, this helps to paint the picture not only of where the current numbers lie with current rates and things like this, but also just helps to clarify the overall opportunity. And again, maybe this is, if you have reserves, if you have a positively cash flowing portfolio that can support some negative cash flow and you can save reserves on this, right? Maybe this is part of your retirement plan or your tax plan overall. But if you can buy 5 properties with minimal money down, and you can weather the storm of a few years of negative cash flow to create over or close to $1 million in projected equity over that period of time, which you could just cash in on, or you could 1031 to boom, get right into a commercial property or a larger property, and also helping to justify yourself as a seasoned real estate investor in the eyes of commercial lenders and things like this and other business partners, showing a stabilized portfolio like this. This is dramatic, right? Most people could probably retire off of just investing $1 million at, whatever percent you want, if you want to use leverage and buy more real estate in addition to other things that you're doing. So I will quit rambling on. I think you guys get the point. I hope this is beneficial for you and has helped to paint a clear picture where we currently are with these products, with current rates, and how this makes sense. If you have any questions, please reach out to our team. We'd be happy to go through your individual scenario. Certainly get on and play around with our wealth calculator. It took us, over a year with a software developer to put this together for you to kind of paint how is your portfolio going to be performing long term and add in your other properties here. Guys, we're here to educate you and help you, whatever makes sense for you. Even if you don't want to do the 100% finance product, that's fine. Let's talk about what is right for you. Everyone, thank you so much for your time.